Well, good afternoon, everyone. This is your host, Rishi Agrawal, welcoming one and all to yet another round of fireside conversations. Today, I have the pleasure of hosting a very senior veteran from the compliance space who has spent a lot of time with all the three constituents, the regulator, the academia, and now the industry as well. Before I introduce you to our panelists today, let me take a minute and introduce our topic. We all know the world of finance is on fire. We also know there has been a tremendous development in credit growth, in financial inclusion over the last few years. Banking as well as shadow banking institutions and NBFCs have played a vital role in enabling this credit growth. They've expanded significantly. They've innovated sharply. Many of the NBFCs have gone on to develop newer, more innovative financial products, leveraging technology, and they have become disruptors in their space. They've grown exponentially, and so has the challenges of managing compliance in those spaces. We've recently seen a lot of discussion around hyperactivism of our regulator. A number of regulatory changes have come through. Many of them affect the life of a compliance officer. Many of them require changes to be done not just at their own level, but also analyze, synthesize, assimilate those changes, and make systemic changes both in technology and human behaviors throughout their organization. By no means is this a trivial task. This requires a lot more than just hope and just having a strategy. It requires people to be in the trenches, completely connected, knowing what is going on, what the obligations are, and making sure that all of this is being done real time so that the company can stay on the right side of the law. So with that, let me introduce Dr. Mallikarjun to all of you. Dr. Mallikarjun is a distinguished compliance leader with a dynamic career that spans banking, insurance, and academia. Currently, he serves as a director and group head of compliance at Religare Group, as well as the chief compliance officer at Religare Enterprises, overseeing a broad spectrum of compliance operations, insurance, finance, and SME sectors. He has a PhD in corporate law and a foundation in agriculture and genetics. Dr. Mallikarjun has also held prominent roles at RBI and IRDAI, contributing to the policy, training, consumer grievance redressal, among others. His academic tenure includes leadership roles in designing programs at Symbiosis University and law instructions at Lloyd Law College. Known for his robust experience in compliance, non-banking finance, and legal governance, Dr. Mallikarjun exemplifies dedication to the financial regulation and skill development within India's financial and legal landscape. Dr. Mallikarjun, thank you very much for taking the time today. We really appreciate it. Welcome to the show.
Thank you very much, Rishi, and thank you to Team Leads for having me here.
So, Dr. Mallikarjun, you have a unique distinction of serving in the regulator, in the academia, and now I think you're closing the loop with the industry.
Yes, it's been one roller coaster of a ride, but the important part of it is something which has been driven by me and my initiative, and God has also helped me good enough.
Excellent. So let's start this conversation. I'm really excited about having you on the show. We've been working with a lot of NBFCs, over 100, and some of the largest in their respective spaces are being served by us. There's a lot of dialogue around regulatory changes, complexity of managing regulations. In many cases, people are talking about regulations stifling creativity and innovation and disruption. And I have a little bit of a different view on the subject. Let me bring you into the conversation. Let's hear from you as to why managing compliance in an NBFC is so complex. What contributes to this complexity?
I can give it from my own example as far as the institutions which are there in my group are concerned. So I'm with Religare Enterprises Limited, which is a core investment company. So there is a master direction on core investment companies which has not yet been updated. The second is we have a SME financing subsidiary in our group called Religare Finvest Limited, which is for which the SBR direction, scale-based regulations, master directions have come, and the consolidated version of it is up and running. The third company in our group is an affordable housing finance company, which is Religare Housing Finance and Development Corporation Limited. So there is a recent circular which has come about saying that we are integrating and doing the similarity between the housing finances and NBFCs, because now we have made it a category of NBFCs. So from that perspective, over the past 2 or 3 years, there has been a lot of change. So I have in fact written an article talking about the changes in the regulatory approach to NBFCs. So before 1997, the focus was only on deposits, then was only on getting information about deposits. The 1997 amendments to the RBA Act brought in the focus, and we wanted to focus on the deposit taking companies. And then we just registered the non-deposit taking companies. As far as my core investment companies is concerned, the story is very different, because once we gave registration, then we took back registration, etc. Then from the point that we reduced the number of deposit taking companies, the focus shifted on the non-deposit taking companies, because there was a build-up on assets and there were interlinkages with banks which went on. So then we came out with this terminology called systemically important NBFCs. And here also the focus was on deposit taking, systemically important, non-deposit taking. Then the third thing came about where they were not taking deposits, but they were taking leverage from the banks and other modes of borrowing. So then the concept of public funds came in. Then subsequently they said that public funds is okay, are you having an interface with customers? So customer interface became important. Then now we have a convenient marriage between the entity-based classification and a very similar approach to banking as far as NBFC regulation is concerned. So you have a top tier, which is all very few companies which are treated almost akin to banks. Then you have a middle layer, but even now there is a lot of diversity in terms of institutions which are there in this middle layer and base layer. So the problem here is my core investment company is in the middle layer because it is a core investment company. Housing finance company, because it's a specialized finance company, is in the middle layer. A microfinance institution is in the middle layer. Then a normal NBFC which is having asset size beyond a certain size is also in the middle layer. So Religare Finvest Limited happens to be in the middle layer. Then the bottom layer consists of a peer-to-peer lending platform, which is just a technology space. Then you have an account aggregator NBFC, which is just an aggregator and again a technological tool for facilitating display of consolidated information. So the regulatory focus has been shifting all through, and more the regulatory approach was to keep them aside from the banking. The urge and the tendency has been more and more into bringing the banking regulation into NBFC space. And because of the diversity in the institutions, bringing them together will become something which is very difficult. Harmonizing regulation has been something which has been very largely talked about. So in this exercise of harmonizing, there is a lot of diversity between the regulation applicable because of the institutional diversity. So that's a big challenge, and the evolving regulations with time also keep adding to the regulatory challenge. Not in terms of the regulator's challenge, but in terms of a regulated entity to cope up with the regulatory requirements. That challenge as well becomes very challenging.
Well, very interesting thoughts there. For our audience, I do want to let them know that on last count, there were close to 10,000 NBFCs in the country. And NBFCs have contributed very significantly to the share of credit. Close to about 24% is what the statistic talks about. And the sector has continued to grow exponentially. Many of the NBFCs have added a tech layer to it, and they have become fintechs and vice versa as well. Now, Dr. Mallikarjun, we have recently seen that the regulators have become fairly hyperactive. There are a number of regulatory changes constantly going on in the space. For our audience, these include circulars, directions, master directions, notifications, guidelines, and so on and so forth. These are being issued regularly. Things like scale-based regulations, master directions on fraud and risk management, directions on willful defaulters, disclosure of key fact statement for loans and advances, direction on outsourcing of information technology are some examples to quote here. What are your views on this? Is it adding complexity or is it enabling the growth of the ecosystem in long term?
Coming from the regulatory space, whenever I've been in a regulated entity also, I've had this feeling that I'm probably representing the regulator there. And in a sense, a compliance officer is someone who's the regulator sitting in a company in terms of monitoring the compliance. It's the first stage of supervision over an entity. But I personally feel that this change, part of it is necessitated by the requirements of the sector. Like I told you, scale-based regulation was necessary because there was this, we initially had this investment companies, loan companies, then we had equipment leasing, hire purchase. Then they combined that equipment leasing and hire purchase into asset financing, combined the loan and investment to loan investment. Now you have an ICC, which is investment and credit companies, which includes all the asset financing also because it is credit. So an approach to scale-based regulation is something which was necessary to bring out which of those areas of banking regulation and which of those entities you want to bring into that level of regulation. So scale-based regulation, definitely it is something which was the need of the hour in terms of finding out an alternative approach. It's not that the last word in terms of the approach to NBFC regulation is said. The second part, as far as this willful defaulters circular is concerned, there is a Supreme Court, there is a judgment in relation to not giving an opportunity before you are placing someone with the civil consequences of not being able to mobilize money, etc. So that judgment had to be brought in, and there had to be the tweaking of the regulation to facilitate the principles of natural justice to be incorporated. And in fact, we've had our own company where this issue was there. We are still fighting cases where we are trying to get the orders implemented insofar as our company is concerned. So that's the fraud, willful defaulter and the fraud. This is the context in which it is necessary. Key fact statements was long overdue because the biggest problem that we are facing today in the NBFC space is there are so many digital lending institutions which have come. Then there are NBFCs which have into indiscriminate lending. And one of the most important protection that you can give to a customer in terms of while dealing with a lending institution is adoption of fair practices code. And if you recall, there was an MITC in the credit card space, most important terms and conditions. So everything that was happening, nobody used to comprehend whether they are paying 40% or 400%. So the MITC in the credit card space came about. That was almost a decade ago. But there was nothing in terms of what is the key regulatory aspects or key business aspects in the lending that is happening. So this key fact statement was long overdue. Thankfully, it has come now. So the fair practices code and leaving it to the institutions, we thought that would be a better way as a regulator. But then when the supervision reveals that there are so many glaring goof ups or maybe intentional or unintentional wording of clauses, etc., it's better to have a key fact statement which builds out the key elements. In fact, if you see the insurance space also, now they have come out with something called as a customer information sheet in the new policyholder protection regulation, which is a wonderful document because it's a single term which gives a paper which gives you in simple words what are the key aspects in relation to that financial product. So that is, in a way, the evolution of regulation happens, and it happens in fits and jumps sometimes, because you are thinking that you have allowed a system to come in, you want that to run its course. But in the meanwhile, because of supervision, if so many new developments keep happening, and with the financial technology coming in and players coming in, and the need for faster and quicker access comes in, automatically you have risks emanating out of it. When these risks are not probably properly addressed by the company, the supervisor and the regulator comes in, and when he notices that there is something amiss, and it is amiss amongst lot of players, then automatically this triggers a regulatory intervention. So, but this will we'll probably have more stable regulation, because now I think from the technology space also we've reached the evolution will happen, but the protection that needs to be provided through the digital lending guidelines, then outsourcing guidelines, etc., these probably will continue with small tweakings depending upon the need.
No, very well said. For our audience, I do want to let them know that in many inspections and audits, the regulator has found instances of mis-selling, privacy breaches, unfair business practices, exorbitant interest rates, unethical recovery practices, hostile and abusive recovery practices in many cases, improper KYC handling, improper assessment of income, neglect of borrowers' repayment capacities. All of these have been examples of items that the regulator keeps finding, and then appropriate interventions are required. So, totally agree with your view on the subject, Dr. Mallikarjun. Moving on to the next topic of our discussion today, what are your thoughts on areas where technology can play an important role in making NBFC operations more effective, more efficient? We've seen that RBI has come out with a circular earlier this year in the month of January on mandating technology-based systems to be utilized for compliance tracking and management. And we've seen a lot of traction in that space. Technology certainly helps in many areas. It has made operations simple, more efficient, ultimately less expensive, and hence it benefits the end consumers in the end. What are your views on leveraging technology in this space?
See, the NBFC as a concept itself was supposed to be a bridge, the last mile connectivity between a bank and a customer. So that's the basic concept of an NBFC. But now, even with the NBFCs and the banks being there, still we find that the financial inclusion, it needed a Jan Dhan Yojana to be there, then Aadhaar linkage for ensuring that the benefits are passed on, so that these customers who are in need of a bank account do open a bank account. Then with the all-pervading presence of a mobile, the combination of this Jan Dhan, Aadhaar and mobile has opened up new areas in terms of how we are going to reach out. So that if you see all the technology that is happening, it is around these only. So you have CKYC, and because of CKYC, you have an automation of the loan process, application process, and maybe there is a thought of having a digital public infrastructure by having something akin to UPI. You want to have a unified lending, interface or something. So that's one space. So how does that happen? One, you have already an infrastructure in the form of CKYC. You have assessment tool in terms of the creditworthiness through the credit information companies information, etc. that is there. Then you have an account aggregator which is going to provide you with an entire background about what your assets and liabilities are. So the biggest advantage of the tool of technology that is available is in terms of basic underwriting or taking a decision insofar as the creditworthiness or otherwise. Credit scoring is another important area where technology is playing an important role. Then peer-to-peer lending platforms. By having a totally platform-driven mechanism of having the loan dispersal and other things is an important area. Fraud prevention and detection and prevention is another area where technology is being used extensively, not only in the banking and the NBFC space, but in insurance, it becomes all the more important that you are using technology for fraud prevention. Then apart from that, the fact that you have the entire history of a customer before you, it enables the technology tools to provide them with customized portfolio management services. You have customized products in the insurance. You have customized lending or deposit or investment kind of products which are being offered by banks, etc. So then you have the opportunity to cross-sell, showing that I have a wonderful bank. I'm able to sell my wonderful insurance product and my wonderful general insurance product. So this mechanism of technology and the integration of it is also enabling greater access to financial services through the use of mobile and through the digital applications. Then you are probably moving towards this open banking where you have a single device and a single mechanism through which you can access all your financial resources. I feel that deposit is a wonderful way now. So I will close my useless insurance policy and then take a deposit all sitting with a mobile in my hand. So that's the kind of this APIs that are there, interfaces that are being built, etc. So maybe open banking will be the ultimate reality of the whole technology supporting the entire financial infrastructure. So the banks, insurance companies, mutual funds, pension, all of them, interoperability between all these. If that is enabled, if and when that is enabled, then probably I feel that technology is totally provided. And not last but not the least, if it is going to give the customer a satisfaction and a confidence that his data is not going to be compromised and his account is not going to be siphoned off by all the scamsters that are there in this world, it is then that we can feel that we have rightly arrived as far as the technology is concerned. But now there is a lot of quick sell in terms of financial technology that is happening, and that's the reason why there are two big things coming up in the form of regulation. One is the digital lending related guidelines that are there, and the second in terms of outsourcing, and the third is a legal protection that is coming through the data protection law that the government has come out with. So this is how I look at technology and the regulation around technology as well.
Oh, very well said. I think there were a lot of deep ideas there. One, portraying the complexity of compliance management in today's fast-changing world. Second, the evolving world of fintechs, what the future stores for us, and how technology can bring a lot of these diverse platforms together for a unified experience as far as customer-centric innovation is concerned. Now, that kind of brings me to the next area of our discussion. We've seen a lot of adoption of products offered by fintechs in the recent few years, leveraging technology for penetrating their products in a geographically agnostic manner. Somebody sitting in one metro city building an app can technically lend, in different parts of the country, wherever there's a smartphone with an app and internet connectivity. Their ability to do KYC quickly online using the mobile platform, making credit decisions using technology, and offering credit in a matter of minutes. Now there's a race as to who can offer credit faster. It's like
30 minutes.
Right. In a world which is rapidly transforming with technology, how are traditional NBFCs coping with them? How are they managing their changes? Their business models in these modern times? Is it denting their ability to grow at the same rate?
See, the point is that there is a need for adoption of technology, and as far as your traditional NBFCs is what you're talking about. In fact, my PhD was on one of the earliest NBFCs that were there, which is Nidhi companies. So what they do is they have their own customer base. They have no fancy ideas of expanding their footprint across the whole country. So they work in a localized area and then they operate and serve their customers, and that's all that they think about. But traditional NBFCs which have an aspiration to get big, enhance their reach and other things, they will definitely have to adopt financial technology one way or the other. Most of the times what they do is they are partnering with entities, with the fintech entities. So there are a lot of entities who come out with proposals. Then now you have the regulatory sandbox kind of a thing that is there, and then RBI also has come out with an innovation hub which validates all these things. Then you have various of these options that are there. So the banks will parade that this is an option that I am going to provide by tying up with a NBFC will probably tie it up with them and then say that this is something which I want to do. Then you have it operated in a limited scale and then you go about doing it. So most of the traditional companies are also going into this space to enable better customer experience, because if you are not providing with them the option, the customer will find another place from where he will go and get the service. So it is in their own interest that they adapt, then they adopt, and then they thrive. So that's the simple philosophy that is there, and that's the reason why most of the, if you see, the innovation in terms of banking started off with foreign banks coming with those products. Then the private banks caught up, and then now SBI stands at the apex in terms of all kinds of innovation. You have an yes or no kind of a thing. You have chatbots providing with customer service. You have chatbots providing you details of customers. So traditional NBFCs or modern NBFCs. The modern NBFCs, it is their USP with which they come about. And traditional NBFCs, they say that we are also tuned to changing times. So we are also adapting and we are providing the same kind of service which the new one is providing. So please don't leave us. Continue with us. We are here and we are cognizant of the changes that are happening across the world.
Lovely. Very well said. There's enough space in the market for both kinds of players. And we've seen a lot of technology-based innovation happening in traditional NBFCs as well. They have their eyes and ears closer to the ground. They have direct customer interface. They have branch locations where their people connect, consumer connect is much better. Their ability to garner intelligence from the ground is much better. So some of those things are definite advantages. But one of the questions here is, with all this disruption enabled by technology, new business models being created, disruption is happening faster than regulators' ability to make new rules and tame some of the innovation that is going on before it dents the credibility of the sector. What do you think are the challenges in front of the regulator while dealing with all this technology-based disruption that we see all around us?
See, one of the there was a monetary policy conference where there were a lot of questions that were asked about Paytm. And in that particular case, Governor Shaktikant Das made a wonderful, a 2-minuter or a 3-minuter in terms of what is the regulatory approach to non-compliances. So similar is the case of regulatory approach to change also. So one thing is, you have first, there was no regulation in this world, and similarly there was no financial regulation. Okay, there was no institution of marriage. It came subsequently. Okay. So when there was no regulation, I'll only take the example of NBFCs itself. There was no regulation of NBFCs. Then they found that the credit that was provided and the operation of the monetary and credit policy is the responsibility of RBI. So if banks are only providing them, I understand what is the lending and deposit activity. But here came these institutions which are non-banks, which are providing similar services. The only two differences between a non-bank and a bank is that they can't take demand deposits, and the second thing is they can't issue checks. These are, and the third difference is in terms of not having deposit insurance, but they can do everything and something more than what banks do. So once you find that these entities are there, the only thing that you don't want to regulate them. You want to get information from them. So that's why in 1963 we came out with the amendment of chapter 3B, which is the entire regulatory framework that came into being. Then you found that these institutions were there, then they were taking deposits at very high rate. So they were not, you brought them under the discipline, you came out with deposit directions. Then there was no prudential norm at all. They were not having any mechanism of regulation on the asset side. You wanted to bring them through, but how did you bring them through? Initially in 94, what we did is, you follow the prudential norms, I will give you interest rate freedom. So this way, you are going carrot and stick kind of a policy. You are doing the carrot first. Then they didn't do that, and there were certain other issues which came about. In 1997, the regulatory framework of NBFCs came about. So NBFCs, if you see, Canara Bank started off as a Nidhi. But then when did the banking system was long in existence. Banking Regulation Act came about only in 1949 as a Banking Companies Act. Then cooperatives were brought in. So similarly, NBFCs were brought under the regulatory fold. Then, as I told you, deposits was the focus. Then the focus keeps shifting. And this is what happens with technology also. You allow someone to operate, the entire beauty of NBFC space is that they will see where there is a gap. Regulatory gap and regulatory arbitrage is one of the biggest things which NBFCs have done it. And credit gap is also something which they have done. Nobody did second-hand vehicle financing, which only now banks are very eager to do. At that point of time, it was only these companies which were there in Chandigarh, North, Haryana, etc., which were very actively engaged in these kind of financings. Down south, the Sundaram Finance and other, these were doing businesses where there was a need, there was no institutional mechanism to do that. So similarly, there is a need in terms of providing a particular kind of service or particular ease of service. That is where technology people will come. Then the second thing that the regulator sees is it in the interest of customer and is it creating any risk? If it is in the interest of customers, fine. If it is creating a risk, find out whether you can mitigate the risk by operating the tools which are within your basket, by controlling the institutions which you already have in your control. A classic example is your, Bitcoins. They didn't go after the Bitcoins first. They went and said that the banks should not permit doing this. So the approach is basically to deal with the existing framework to attack the problems that could be caused. When they find that the problem is so bad and they will not be in a position to deal with it at that point of time, first what they will do is they will prohibit, or what they will do is they regulate. So the stage of happening is that there will be an innovation, there will be a check in terms of what is the customer implication, what is the regulatory implication, or is it a pure case of regulatory arbitrage? If it is a pure case of regulatory arbitrage, no problem. Is it in the customer's interest, and is it going to create a risk to the system? If it is going to create a risk to the system, how do you mitigate risk? If this risk cannot be mitigated unless I come out with a regulation, then I come out with a regulation. And if the problem is so huge that I am not willing to let the customer be a pawn to this whole thing emerging, that is when I will go and ban it. Like what we do in relation to maybe a price chits and money circulation schemes banning act was something which was thought. So initially the chit fund is a regulated business, but then some people said that I am going to do a price chit, then this multi-level marketing, etc., which became a big issue. So the only option that they took is you ban the whole thing. So that is the regulatory approach. So the regulatory approach is always in terms, and if you see the kind of steps that RBI and other regulators have taken, everyone comes out with this regulatory sandbox, which is saying that you are having an innovation, you feel that it may hinder the regulatory, or it is operating within the regulatory space, or it is on the fringe. You want to test it out in terms of its efficiency and effectiveness, you have an option. You register yourself here, you test out your product, and you are fine with it. I am fine with it. Then you go ahead and deal with it. Then RBI itself creating an innovation hub is something which is fantastic. So the kind of talk that Mr. Debashish Panda gives in terms of IRDA along with the councils coming out with a Bima Sugam, it's a fantastic thing. So these kind of innovations that keep happening, the regulators now are someone who are proactive in terms of encouraging the institutions to innovate. But they are also cognizant of the fact that the customer's interest, which is the basic, if you see the NBFC regulation, the protection of the depositor's interest and ensuring financial stability. Here, when you're talking about insurance, it is protection of policyholders' interest and development of the insurance market. So similarly, in case of stock securities market, protection of shareholders' interest, investors' interest, especially the small investors. And then you talk about all your innovation. If this is a non-negotiable, depositors' interest, system financial stability, then policyholder protection and investor protection. Beyond this, any innovation is welcome. And if it goes beyond the walls of regulation, and if it is going to hamper the protections that are supposed to be provided for, regulator has to step in. There will always be a lag in this. The only thing that regulators should be cognizant about is they should keep interacting more and more with the market to see what is happening. In fact, IRDA has very few people. It's a 500 or 600 people organization. RBI has shrunk drastically. When I joined, it was about 29,000. Now it is around 10,000 or less than 10,000. SEBI is also in around the same space. And imagine the nooks and corners from where you could have potential mischief players operating. So there has to be some mechanism, and one of the mechanisms is to bring the state governments to the protection of depositors' interest legislation, which has now become a central legislation. So these are all the ways in which the changes happen in the regulators. It's almost like a cat and mouse game happening over and over.
Oh, very lucidly explained, and I'm so glad we are having this chat. There are so many youngsters who are joining the regulatory and compliance space and are not very familiar with what has been the regulatory thinking around the subject, what are regulators' considerations when new regulations are brought in, how do they approach creation of these regulations while not compromising the disruption initiated by technology. Now, One of the things that we are constantly seeing, Dr. Mallikarjun, is traditional NBFCs are expanding quite rapidly as well. The only vehicle for expanding is via an increased geographical footprint. Many of them are setting up new branches across different states. Some of these NBFCs go into not just a few hundred branches, but a couple of thousand branches, if not more. What are the regulatory and compliance challenges? What are the risk challenges that they encounter as they expand?
See, you have myriad laws across states. So that's, but when you are having a place of business, it opens up so many other aspects to it. You have your local Shops and Establishments Act, you have the GST and other related implications, then you have several labor related protections that are there. All that entire gamut of legislations that go into the places of business is something which nobody, if my company wants to open a branch elsewhere and what could be the regulatory implications there, it would take me quite some time to get to know about that. And this is where there is an ease of doing business, but you can't simplify everything that there is no law at all. No? You need to have laws which are local. Then there are certain financial implications of having local laws, which we already know in this GST era. So it is necessary that you have laws, but the places of business expanding across the geography throws up new challenges in terms of understanding what are the regulatory requirements, local regulatory requirements. And unless we have a compliance tool which is providing us the whole gamut of regulations, it will take a hell of an effort for us to just get a hang of what things we are doing. And the beautiful tenet of law is that you cannot feign ignorance or you cannot claim ignorance though it is genuine. So you are bound to comply with the law because you are bound to know the law. And how do we know the law when there are such number of legislations that are there or rules that are there? It's only when we have partnering with a technology support which provides us a tool which has the information about the laws in Ladakh. We will not be in a position to do that. But Ladakh becomes very important because that's an underbanked area or an undercovered area. So there is an opportunity there. So we would like to have people or business expanding there because there is an opportunity there. So that's the challenge where I think technology platforms like yours comes handy for us.
Sure. Well, for our audience, just as a revision, there are 7 categories of the law that governs doing business in the country. There's a web of about 1,536 acts and rules that apply to entrepreneurs. Embedded in them are about 69,000 plus compliances with 6,618 unique filings. Not just that, there are 2,233 websites around the country which publish regulatory updates. So if you are an NBFC which is looking to expand, believe it or not, hundreds of compliances, unique compliances, and thousands of total compliances may be applicable to your business. You're governed by union, state, and local body regulations. A lot of these local body regulations are governed by shops and establishment and so on and so forth. A company like TeamLease Regtech builds products which come integrated with the compliance database of the country and has the right expertise to help you grow responsibly as you move forward in your journey. Now, we are coming to the last question of our conversation, Dr. Mallikarjun. How do you envisage regulatory ecosystem changing so that NBFC sector can continue to grow and contribute to the development of the economy?
Basically, the regulations, now it is time for us to have a pause in terms of having our existing regulations run their time to understand how they are performing. So as far as the technology, you have a lot of support in terms of regulatory instruments that are available with you. You have an act which has been relatively stable, so you are able to, with the last amendment, there is immense power that has been given to Reserve Bank in terms of controlling the management also. Then you have the second leg in terms of the frauds, willful defaulters, etc. You have the outsourcing guidelines which have come about. You have the scale-based regulations which have come about. Then your housing finance directions have all been spruced up. So I am looking forward to our master direction relating to CIs is also getting updated with the changes that have happened with the SBR space. So technically, then you have the digital lending related things which are going to provide you with the basic framework as far as the NBFC regulation is concerned. So now the important aspect for the regulated entities is to comply with these regulations and bring out any problems that are there, so that the tweaking of it in the interests of their business and in the interests of the sector happen. The next important part of it is the customers to be educated about what are the protections that are being provided. That's one of the most important aspects which is missing. So when someone is in desperate need of money, you can't tell him that you will check whether he is registered with the NBFCs. He is a registered NBFC, and there are regulatory provisions which say that you will have to provide all this requisite information. So that is one area where there has to be some honesty while these institutions grow. And there has to be some support in terms of providing them with this option, where again, probably the Google search is something which a lot of people do. But in a crisis, other than for a medical second referral, you don't go to the Google. You say that this guy is there. There is a pop-up which comes saying that I am providing you a 5 lakh loan and I have an emergency here. Then I go click it and get on with it. So this responsibility in terms of the institution is something which is very important. The regulator has to, there is RBI, as far as RBI is concerned, I can say for sure that they have a frequent cycle of inspection, supervision, etc. And they have a reasonably good system in terms of the cycles of inspection, etc. But in the insurance space and in the broking space, it's not so regular. It becomes a bit of a challenge. As far as NBFC space is concerned, you have to be compliant, and that's the only way if you want to continue in business. And as far as the regulator is concerned, he will come after you, and we have seen so many instances of action being taken against entities like DMI Finance, JM Financial, then microfinance entities, then gold loan. So they are not sparing any effort in terms of disciplining the institutions. And one good thing that RBI has done is it has written to all the companies saying that you put these press releases that we have given to your board, so that they are also apprised of what are the reasons of non-compliance which has triggered these regulatory actions by RBI. So this is something which has to happen, and this kind of awareness has to go to the customers also, because ultimately when you're committing yourself to a financial service, as far as banking and NBFC is concerned, it is over in your lifetime 99% of times. But in case of insurance, you get to know whether an insurance product is good or not after you are dead. But then that point of time, you don't even know. It's your family which is going to deal with it. So that's the reason why some sense of responsibility, education as a tool for enabling customer to have confidence in the institution. This is something which NBFCs have to do, because they have been traditionally the most bad boys in the whole group. And it is not that insurers have been good boys. It is just that they were all taken over into LIC and GIC, and their liberalization is just 25 years older. And similarly, in case of NBFCs, their regulation is 27 years old in the Chapter 3B amended form. So responsibility and showing the regulator that they are concerned and they are very important. They find regulation and the compliance with regulation important is very important. And here you have two other cogs in the wheel. One is your internal audit systems that need to be there, and so the next part of it is your external auditor who also has to take, and not last but not the least, the board and the compliance officer also have a very important role to play in it, to give the confidence to the regulator and also to repose faith in the customer that it is their interest that they are interested in, without having or overlooking the regulatory requirements that have been placed. That's the essence. So I think NBFC regulation does not need any more change like what you have in the arbitration law. Every second day there is a judgment, and then there is a new committee which is set up and an act which gets amended. So at least in the NBFC space, I think regulatorily we have reached a point where we have sufficient regulatory protection that is there. Now it's up to the institutions and the public to take care.
Well, excellent points there. It's very clear that all these changes that we've recently seen in the regulations is in response to certain core tenets that the regulator stands by. Technology has continued to disrupt the environment and pose new challenges. I think the regulator has done a fine job ensuring that the core tenets and the core principles of consumer-centric protection are not compromised. I'm glad the ecosystem of fintechs continue to expand, ecosystem when NBFCs continue to innovate and satisfy that gap in the environment which they serve very well, and they also help deepen the credit penetration and financial inclusion as a subject as well. However, growth comes at a cost. There is a cost of compliance, there is a cost of being responsible. All of those are important ingredients. It's very important to stay on the right side of the law. I think Dr. Mallikarjun mentioned that ignorance of the law is not an excuse for non-compliance. If you think compliance is expensive, try non-compliance. We've recently seen a number of regulatory interventions where even some of the most glamorous fintech companies were penalized heavily. Some of them ended up losing their licenses to do business as well. So I think the regulator is very serious. Chalta hai, hota hai culture is not going to work. And I'm so glad that the right amount of interventions on the regulatory side are happening so that ecosystem can continue to prosper and flourish in a very responsible manner. So this brings us to the end of today's discussion. I'm so glad, Dr. Mallikarjun, we could get your time for this wonderful conversation. Some of the budding compliance professionals who have often missed going through the history of what regulations do, why do they come up, what is the regulatory approach, and how some of these need to be taken up by the industry. I hope they've gotten some good insights from our discussion today. So thank you so much for
Thank you very much.
And we really hope to stay in touch and bring you back for some exciting discussions for our audience.
Thank you.